All right, welcome Rajiv, and thanks for joining us to discuss our Q4 financial performance as well as a number of other issues that I know people really want to hear about. But let's start with the fourth quarter, and actually it looks like it was pretty decent.
Yes, in some ways it was. Our focus on profitability and cash delivered some good results. Our non-IFRS operating profitability for the quarter was 5%, which was comfortably the best of the year, as you would expect in a seasonally good Q4. And that lifted us to a full year non-IFRS profit of 254 million euros, which was roughly double that of 2010. Although still obviously pretty slender, given that we exceeded 14 billion euros in sales during the year. On the cash side, we experienced very strong end-of-year collections and overall net working capital management that meant that we recorded positive free cash flow of 446 million euros.
So it sounds like then overall we took some real steps in the right direction.
We really did. And compared to some previous quarters, it's encouraging, and we can reflect on Q4 with some satisfaction. But please, nobody should get carried away, because as well as some of the more positive numbers, there are still plenty of figures that raise concerns and reinforce the need for urgent change. We still recorded a net loss for the quarter, 26 million euros, and that takes cumulative net losses for the full year to over 700 million euros. That is a sobering number that we should all take note of. And despite the strong Q4 cash collection, our overdue receivables still stand at nearly 650 million euros and are higher than they were at the end of Q4 2010. Overall, we recorded negative free cash flow of 665 million euros in 2011, after including the 680 million price of the acquisition of Motorola's wireless assets. And if you consider that our Q4 gross margin of 29.2% was the best we achieved in the year, after a lot of work, but we will still likely be much lower than our European competitors. Well, then you understand just how far we still have to go, and why I talk of and will continue to talk of the need for urgency.
Yeah, no, understood. So let's talk about sales performance. And actually, our sales declined year on year for the first time since Q2 2010.
Indeed, Barry, it did. And of course, it's never good news that sales fall in an industry that needs scale. And they fell about 4% year on year in Q4. But there are reasons for that decline. Firstly, it's pretty clear that the market conditions changed markedly in the second half. In the first half, we enjoyed the benefits of good market growth, but that slowed quite dramatically towards Q4. And it's likely we're heading into a period of lower investment. Secondly, the decline reflects some of the priority choices we are making within NSN and the fact that we're looking to achieve more balance between sales growth and value. There is a worrying trend, though, that our overall equipment sales are falling. In Q4, our services business grew by 3%, offsetting a relatively sharp decline in equipment sales.
Okay, so let's spend a moment on some of the positives for the quarter, because there clearly were some, and would you like to pick out a couple to share with people?
Well, first, our team in Latin America should be feeling pretty pleased with themselves, while they also have areas for further improvement, and I won't let them off without an area of improvement, such as getting their portfolio mix right. They achieved double-digit sales growth and beat their targets for both sales and contribution margin. So well done to them. I'd like to highlight the efforts of the West Europe team as well. Europe has been a tough, really tough battlefield over recent times, and to turn in sales that were essentially flat year on year is a creditable effort. The services business also performed well with continued sales growth and a welcome uptick in profitability. All in all, good momentum in services. As we execute on our strategic choices in the area of services and look to leverage our global delivery capability more, we need to be able to sustain the profitability improvements in services to get to benchmark levels in the industry. Finally, I'd just like to highlight the impact that stronger software sales can have on our profitability. We had a good late quarter run of software sales that lifted the overall proportion of our software sales to 29.3% of total sales. That compares to an average of less than 27% for the full year. And that makes a huge difference in our profitability, as you can see from the decent Q4 performance.
So those are some of the big issues, but actually just before we started shooting this video, you and I were talking about some of the non-sexy areas of progress, which actually I found pretty interesting. How about sharing some of that with others?
Sure, and actually they're examples that are pretty sexy to me, honestly, as it shows that we can make real progress in areas where we have struggled for a long time. They're not about the mega deals, although you know me, I love those as well, but about really close to the ground, small efforts that add up to something meaningful. Think about overdues in cash. The India team collected some ancient overdues from BSNL and Videocon. All overdues, 16 million euros worth, were brought in from UCell. Some of these overdues allowed us to reverse our bad debt provisions, thereby contributing directly to the bottom line. We were able to exit a very bad project in Norway. The Middle East team delivered a real breakthrough with the highest cash collection in a long time. And Africa made some real progress around overdues as well. So although we reduced our overdues altogether and inventory quite substantially in Q4, all of this directly contributed to the positive cash flow that we saw in the quarter. Or think about our priority business areas. In customer experience management, we saw good momentum in the quarter with customers like Orange, Poland, and China Unicom. And here's my favorite one. In Bharti, our CEM project has gone live, and our platform processes around 1 billion reports every 15 minutes on a live network with data that gives CXOs some real customer insight. On quality, yes, we have a long way to go, and I get that. But I was meeting with the CEO of Indosat earlier this week and heard nothing but praise for our quality, and lots of criticism of a certain Swedish company. Now, these developments show the kind of close-to-the-ground execution that we need, the real disciplined execution that will ensure we have a lot of small activities that add up to something really big.
Cool. That billion number is really quite remarkable. So how about the BRM? I mean, what does the Q4 performance mean for the BRM and the money that people will see in their wallets?
Well, the decent Q4 means a decent BRM, 76%, which is a lot higher than it stood following Q3. But the truth is that we missed our targets on all measures for the second half: sales, profitability, cash, and the customer loyalty index. And the CLI was particularly poor. And that is something that should give us, all of us, a real cause for concern. As we go through our expected changes in 2012, it's absolutely essential that we don't lose touch with our customers. Instead, we should be taking extra care to ensure that we stay as close to them as possible.
Okay, so let's get to some other issues. And so pretty decent financial results for Q4, but we've also talked about a deep restructuring at NSN. And do these results make that restructuring less necessary or even less urgent?
Absolutely not. While you're right about the quarter, it is just one quarter. And one decent quarter in no way takes away our need to move with extreme urgency. Even if our results were better than we have seen for some time, we simply cannot lose sight of the fact that we still delivered a net loss in the quarter, our best quarter of the year, and substantial net losses over the full year. That is just not sustainable over the long term. In addition, we are facing some real headwinds in the market. The strong growth we saw in the first half of 2011 has slowed considerably and could even grind to a halt in 2012. Economic conditions are uncertain at best, particularly in Europe, and competition is still very fierce. Fundamentally, there are still too many players in our sector, and at some point, further consolidation is 100% inevitable. When you add this to the large losses we have delivered over the time and the shareholder value that we have destroyed, we simply have no other choice. In fact, we have simply no other choice than to move fast and to move fast now. 2012 has got to be the year when we get our business in fighting shape for the future.
So let me ask a really blunt question then. I mean, how do you square the need for urgency with the fact that we announced our strategy and restructuring plan in November, but actually haven't shared any new information since then? What's going on, and when can people actually expect to learn more?
That's a very fair question, and I know people are waiting anxiously for news about the next steps. The reason for the delay is simple. Before moving ahead to complete our restructuring planning, we had to renew our credit facilities with a number of banks. With the considerable turmoil in the Eurozone, that has taken longer than initially expected. We have now closed that source of funding. It is frustrating for all of us to wait, I know that, but when we have to prepare to take actions that will impact many thousands of jobs, people's livelihoods, we need to be careful and thoughtful. And that is also what we're trying to do well. And yes, I know this sounds a bit like corporate speak, but it's real, and it matters. We're moving rapidly with our planning process, and we will share more information as soon as possible.
Okay. So let me tackle another kind of tough one about our restructuring efforts. And when people at NSN talk about restructuring, they often take it to mean headcount reductions only. But when you talk about it, you clearly mean much more. And can you help clarify that for people?
Absolutely. It's a great question. I want to be clear that headcount reduction efforts will be only a part of our restructuring. Of course, they are an important part and have to be done in the right way. But our company restructuring must go well beyond personnel reductions. We must fundamentally change our priorities. We must fundamentally change the way we work in almost every part of our company. And so, we've identified 30 specific projects designed to do exactly that. Now, let me leave you with some examples. These range from exiting underperforming businesses to improving our pricing discipline, strengthening sales force effectiveness, massively improving our approach to new product introduction in the field, ensuring our financial systems provide the transparency needed to make better management decisions, focusing more of our services to global delivery and remote management, and much more. These will all drive significant improvements in 2012 and 2013.
So I seem to be hitting you with a bunch of tough questions, and here's one, a personal one for me. And frankly, I think our record of execution in the past has been mixed, and we're now about to tackle massive change in a very short period of time. So how are we going to do all of this successfully?
You are right about our execution track record, and that is something that we all bear some responsibility for. We need to understand where we have not performed in the past and be frank about it so that we can do things differently and get it right this time. That means we have to improve our governance. And so this time, we have created a restructuring steering board that I will chair. It will meet at least once a month to assess the progress of each of the 30 projects under one common umbrella, to give direction and to set the pace for the company restructuring. It will identify potential issues and guide on their resolution. In short, the mechanism to oversee and drive the change. This time, we will have clearly defined accountability, precise metrics to measure progress, and consistent follow-up with a consistent and direct linkage to the P&L, driven by a central program management office. In the past, we have tried to do everything on our own, largely without the support of outside expertise and resources. This time, we have a better balance, with some strong consulting support that will help drive our focus projects, each of which will have an executive board owner. In the past, in the broad ranks of our organization, we lacked a sense of urgency. Today, every employee needs to understand that if we don't deliver against our plan, we put our future at risk. This is a fight for survival, and it is 100% as simple as that.
Understood. So to sum up Q4 in 2011, I guess, some progress, but a whole lot more to do.
Correct. On a high level, the results are encouraging, but we cannot let them lull us into complacency. The truth is that most of our regions and many of our business lines still deliver net losses. Our overdues and inventories are still too high. We have a lot of trapped cash. We need to collect this cash and much more, and we have a huge amount to do still to get even close to best-in-class benchmarks for productivity and efficiency. So in short, good quarter. It's behind us now. We need to keep the pedal to the metal as we move forward, because let there be no doubt, 2012 is going to be a very, very tough year. We face extremely difficult market conditions, some very tough, sometimes irrational competition, and some very challenging times within NSN as we move fast to restructure the company. It will require courage, determination, a lot of hard work to get us where we need to be. But I can see where we need to be. And I know, and I do know this, that we have the right qualities in NSN and the right culture to get us there.
Excellent. Rajiv, thank you very much, and thanks to all of you for listening, and have a great day.